And if time allows, we'll look at accounting for a sole trader. So you've been hearing me talk about financial statements, at least from the time we have been together, you've heard me talk about financial statements over and over again. So basically I don't want to, the purpose of an accountant is for the bigger part is to prepare financial statements. So the heart of finance is in preparation of financial statements. When you understand the basic financial statements, then you'll be able to build on that knowledge to come up with other types of financial statements, but at the other types of reports. But at the heart of reporting, at the heart of finance, we have these financial statements that we are going to be looking at. So keep your mind open, ask where you feel you do not understand. And yeah, so we can get started. So today we'll be looking at basically the objectives of the financial statements and the full set of financial statements. How does this look like? The accounting principles in preparation of financial statements. For those of you who did read, last time we're asking about the principles. For those of you who had forgotten, we have a good chance that we have them under this topic. Then we'll also look at the statement of financial position and the statement of profit or loss or other comprehensive income. So what are the objectives of financial statements? We're saying that the objective of financial statements is to provide information about the financial position, financial performance, and cash flows of a business enterprise. So basically, we know, before we look at this, we know that, of course, every business will exist for a particular motive. No one is going to wake up and just create a business for the sake of creating a business. And we know that 100% of businesses are created, of course, there's going to be money involved. And for as long as there is money involved, there is need for financial statements. So we will never go out of go out of job as a finance person, in as much as yes, AI may come in and whatnot. You find ways of working alongside the technology, but the need for someone who does the finance job is always going to be there, because every single business in the world, as long as it's running on money or it has any small concept of money, it will have need for financial statements, because people need to see how they are spending, people need to see what if they are achieving their business goals, financial goals. They need to know how they are managing their costs. That is for management accounting and performance management. They need to know how they are managing their cash, how they are managing their relationships in terms of suppliers. So it is going to be, it's very, very important. You can't bypass financial statements. You cannot bypass financial statements. So the objectives of these financial statements, like I've told you, as long as a business is existing and it has money involved, there's going to be need for people to know what exactly is going on in that business. So these financial statements come in place to provide information about the financial position and financial performance of a business. So when you talk about the financial position, we are looking at how are the assets balancing against the liabilities. Because when you even you yourself, when you decide to start a business, um, you will say, maybe I have capital of 10 million. So you go ahead and put your capital of 10 million in a business. But we all know that a business and the person are separate entities. So the fact that you've put 10 million in a business, it's like you've given someone 10 million. So you need to know how that 10 million is moving. Hence, you need to know the financial position. Yeah, you need to know the financial performance of a business. Are you making profits or losses? How can you adjust where necessary? How can you increase your revenue? How can you find other sources of revenue if necessary? How can you reduce your costs? That kind of stuff. Then we have cash flows. Of course, you need to know how much cash do you have for your business to smoothly run. Because it's one thing to have very many assets, and people are demanding you east, left, right, and center. So you need to be able to balance the three functions of a business. And it's useful for majorly, the main use of financial statements is to help with making decisions. So we make these reports to help stakeholders make the necessary decisions. I know when you are being introduced to this course unit, You went through the users of financial information. You had governments, investors, suppliers, employees, and whatnot. So all those people are interested in the information, because at one point, for every figure that is going to be shown on on a financial statement, it's going to help in making a particular party's decision, regardless of who they are. The same info, it may not necessarily, for example, what the government may look for may not necessarily be what a supplier may look for, but at the end of the day, you have to provide information that will satisfy all parties. So to meet that objective, financial statements provide information about a business's assets. We all know what assets are: liabilities, capital, income and expense, including gains and losses, contribution by and distribution and distributions to owners. That is when we have, that is in form of dividends and shares and whatnot. That's equity basically, and cash flows. So the full set of financial statements of a sole trader, we say that given the nature and form of a business for a sole trader, a full set of financial statements shall comprise of the following. That is, a sole trader is the person who owns the business as one person, where ownership is by one person. So most of these small businesses that you see, those are sole trader businesses. When you know that there's only one person owning that business, sole means one. So that is a person, one person in their business. So a full set of financial statements, for example, for a sole trader, will be the statement of financial position at the end of the period. So you can notice that the balance sheet will be at the end of the period. We know that balance sheet will keep balances of assets and liabilities. That's why we call it a balance sheet. And I'm saying it like this so that you will remember that with statement of financial position, you're putting balances. It needs you to record balances at the end of the period for which you're reporting. It will also have a statement of profit or loss and other comprehensive income for the period. And this is usually presented as a single statement by presenting the profit or loss section in a separate statement of profit or loss, and immediately we follow by a statement of comprehensive income, beginning with a profit or loss. We'll look at this much better later. We have the statement of changes in equity for the period. So anything that was going to relate to capital, and basically, when we talk about equity, we're talking about resources that a business uses to run, in terms of capital, dividends, shares, and whatnot, retained earnings. Basically, I'm trying to get a simple word for it, but basically it's like the mass of the business. So changes in equity for the period will also, it's also part of what will be necessary for a sole trader, in as much as it's one person, because at the end of the day, every business is started with either with capital, either it could be debt or it could be form of cash. So we need to be able to account for how that moves. We have the statement of cash flows for the period that we'll also look at that if time allows. And then we have notes comprising a summary of significant accounting policies and other explanatory notes. There are things that you may not necessarily have to write in figures, but at the end of the day, they still have to show in your reports. So last time we're asking about provisions. When do we know what to put, and when do we know when to write? Those are the notes you will have to make specific notes at times when you're making your financial statements, explaining some of the figures that you have presented for people. So going concern, we are saying that financial statements are usually prepared assuming that the entity is going concern and will continue operation for the foreseeable future. That means that we usually prepare financial statements with an assumption that in the next period we're going to operate. That's why we have we have balance brought forward and balance carried forward. That kind of thing. It means that you close off with an anticipation that next year or next period we're going to operate. And so you find that maybe if you bought like last time I looked at assets, you find that if you bought an asset, a car, you bought a car in 2017, and then you carry the total, maybe you bought a car of 10 million, and then you carry the 10 million over and over and over as the cost of the car. So as long as the business is operating, you will carry over that 10 million. So IS1 requires management to make an assessment of an entity's ability to continue as a going concern. If management has significant concerns about the entity's ability to continue as a going concern, the uncertainties must be disclosed. So if you're not sure that you may be able to operate next year as a business, you better disclose for people, because at the end of the day, remember, we're supposed to be true and fair in whatever we are reporting. So imagine reporting that you imagine reporting on going concern basis. When you, as management, you know that maybe maybe you took a loan from the bank and the bank is coming to pick its money, but you're convincing people that you'll be, and maybe the bank is going to liquidate the whole company, but you're convincing people that you're preparing statements in a way that you're showing that it's a going concern. An investor will come from somewhere there, look at your balance sheet, calculate their ratios, do their analysis, and decide that they want to invest in the business, not knowing that the business is actually closing, and that would not be right, because now that brings you a whole box of issues. So financial statements should always be prepared on going concern basis if we are very sure that they'll be operating in the next year or in the next period. But in the event that we are not sure or we are uncertain about the future of the business, then we do not report on going concern. So you will see how that is done when we look at partnerships, how we will dissolve we'll create a partnership, run it, change partners, and dissolve it. So we'll see how we close off a business that's not going to be operating anymore in the next years. So we also have another accounting concept called accrual basis of accounting. IS1, we're saying that requires that an entity prepare its financial statements, except for cash flow information, using the accrual basis of accounting. Last time we talked about the accrual basis of accounting. So just for those of us who are not there, we record transactions as and when they occur, not when cash exchanges hands. Unlike for the cash flow statement, we record only transactions that are affected by cash. When we give out money, we show that we've given out money. When we have received money, like actual cash, not when a transaction happens. When we receive cash, we show that we've received cash. So that's the difference with the other statements and the cash flow information statement or the cash flow statement. So every other statement apart from cash flow is prepared on accrual basis. Every single statement, even if you pay immediately and your business is used to pay in cash. Okay, I've seen this happen in practice. Your business is used to pay in cash, and so you kind of forget this accrual concept, because you as a business, you're very, very comfortable enough that you can always pay cash for every single transaction that you make. And then you would start forgetting in case you have to accrue for something. So you find that people start changing and now are operating on cash basis as if NGOs, yet they are not NGOs. So we need to be very, very particular about these principles. Consistency of presentation. The presentation and classification of items in the financial statement shall be retained from one period to the next unless a change is justified by a change in circumstances or requirement of a new international financial reporting standard. What this means is that if you prepare a financial statement in 2022, it should be and it should be similar to what you prepared in 2021. It should be similar to what you prepared in 2020, unless there is an actual justified change or there's like a new requirement. So if you're depreciating, you're going to depreciate the same way for all through the years. If you're disposing, you're going to dispose all through the same way through the years. If you're presenting, maybe you're presenting your income statement, you will have to present, of course, your trading account, the profit, loss, whatnot. Get your expenses, organize them accordingly, and get your net profit. If you're doing your balance, your statement of financial position, you have to be consistent. If you've started with your non-current assets and you've organized them by order of liquidity, let it be like that for the periods all through. Not 1 year it being different, another year being different. Unless, for example, you will find that unless maybe you've changed like an industry and maybe there's like a different way you can, there's like a slight, it may just be slight, very slight, maybe due to an industry, but the changes may not necessarily be very big. And in the event that there's even a change, you have to disclose that and the reason for that change in consistency. But you have to make sure you're very, very consistent all the way from the first entry to your financial statement. You have to be consistent as an accountant. And then we have materiality and aggregation. We're saying each material class of similar items must be presented separately in the financial statements. These similar items may be aggregated only if they're individually immaterial. So what this means is that, for example, when you say you have assets, present assets together. You may classify them as non-current assets or current assets, but present assets together. Okay. You don't it's not good for you to present an asset and then the next line is a liability, or it's not good for you to present an income and the next line is an expense and then the next line is an income. No, 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 no. First, make sure that the class of similar items is presented separately. So you will cluster them as if, and then of course, if they are immaterial, then you may aggregate them. You may put them together and aggregate them. So what this means is, like, let's say if you have maybe like small types of expenses, you may have like very, very usually like these petty cash expenses, those petty expenses, those are the ones you may aggregate. And usually it's because they are very, very immaterial. When I talk about very immaterial, I mean that the figure, okay, the figure of those expenses is not big enough to add to totally influence a financial decision. So when you talk about materiality, we for example, if let's say we have 100, we have 100, 100, let me say, kilograms. We have 100 kilograms of uh of of beans. When we get our 100 kilograms and maybe we lose 1 kilo out of the 100, for us to calculate the materiality of this, we'll get the 1 kilo that we've lost out of the total 100, which of course will give us about 0.01. This 1 kilo, even if it's missing, may not necessarily affect our profits. But imagine we have maybe misstated and we have like 20 kilos out of 100. That's like 0.2. That's like 0.2% materiality. So as a company, of course, you will decide what is material or not. So you find that companies are dealing in billions and billions and billions. Even if you're to cluster, even if you're to cluster like an expense of like 1,000 shillings with another expense of 2,000, that's very immaterial. There's no need for you to even waste time. And now that you're going to that it wastes time that you're going to start separating them. But of course, if they can be separated, the better. Though sometimes we know that different types of expenses may come up, and so it will be up to you to classify and see what goes where. We also have a principle of offsetting. We're saying assets and liabilities and income and expense may not be offset unless permitted by an international accounting standard. So what this is trying to say, you may have your, let me take a scenario, a case of your assets. Okay. So you may have your assets worth 100 million. And then you also have your liabilities worth 100 million, because ideally they're supposed to be balancing off. There is no way there is no reason why you should when we talk about offset, we're just saying subtract one from the other to get a net balance. If you have assets of 100 million, they will stay assets of 100 million. If you have liabilities of 100 million, they will stay liabilities of 100 million. Because you look at it like practically, you see how you may say, maybe this person, let's say me and me and Faith may be demanding each other. I am demanding Faith 50,000 and she's demanding me 20,000. So we decide and say, you know what? Since we are demanding each other, let's offset that. That is not right. Rather, if we have to both, if we are to create our financial, if I create my financial statement, I would show that I have a liability to Faith and I have a receivable from Faith. So you have to not necessarily, or you have to try to avoid as much as possible offsetting transactions. If there are incomes if there are incomes, let them be incomes. If there are expenses, let them be expenses. Sometimes we fall in error and we do it automatically, like in our minds. But with accounting, you have to be very systematic. Even if you know that you offset at one point, you have to be very systematic show what is an income, show what is an expense, write down every single thing. And then if you need to get maybe a net profit, then there you can. That is an offset in its own way, but that is permitted by the standard. We have comparative information. We're saying that IAS1 requires that comparative information to be disclosed in respect of the previous period for all amounts reported in financial statements, both on the face of the financial statements and in the notes, unless another standard requires otherwise. Comparative information is provided for narrative and descriptive where it is relevant to understanding the financial statements of the current period. So an entity. So you've seen for those of you who have seen, I know you have seen public financial statements. So I'm going to take it that you've not. For those of us who have not seen, the easiest I know that you can walk into a bank and you will usually see them on their notice, but you will see their financial statements of the previous period. Or you just get any big company and go to their social media and look for financials. It is important that when you're reporting, you have a year against which you're comparing your reporting. So, for example, if we are reporting for, let's say, we are now in Q2. This is June. We are finalizing Q2. So ideally, for maybe if it's like an internal report, you find a company reporting for Q2 against Q1 2024, or it would report a media 2024 against media 2023, or if it's doing financials for the whole year of 2024, it will report against the financials for the whole year of 2023. So you have to have like comparative information so that someone can see a movement between the periods. Someone can, you don't just wake up and just fall on a year and that will be it. Because take it like this, imagine you are the person who wants maybe to do business with a particular company. You are maybe a supplier, even if you want to apply for a job in a company, by the way, you can go first to their financials and see how they are performing so that you know what you're walking into. But how will you know if they are performing if they don't have comparative information, if they don't have information against which you can compare? So if they tell you that they made a profit of 4 billion this year, against what? But if they tell you they have made a profit of 4 billion this year, and last year they made a profit of 3.5, that means that they have increased their net revenue by at least 500 million. And so that way you will know automatically that they are making progress. If maybe you as an employee, you will probably you as a at this level will probably use the company's financials to see maybe like the salaries and whatnot. So you go to the overheads, depending on what the industry is, you go to the overheads and see how the salary will. If you see that the salary reduced, then there you will know that things may not necessarily be well. So it's important that you're able to compare. Even when you want to invest, it's the same story. You will look at maybe like their assets this year and their assets last year, their liabilities this year and their liabilities last year. So it is important for the accountants to provide information in that way, in a way that it is comparative. You can compare it against another. We can compare the current reporting against the previous reporting. So an entity is required to present at least two of the following primary financial statements. You have to present at least two for the statement of financial position, the statement of profit or loss and other comprehensive income, the separate statement of profit or loss, the statement of cash flows, the statement of changes in equity, and related notes for each of the above items. So a third statement of the financial position is required to be presented if the entity retrospectively applies an accounting policy, restates items, reclassifies, and those adjustments had a material effect on the information in the statement of financial position. Remember the time when we were doing non-current assets and we adjusted, I think we adjusted the years, I think it was the years, or we changed the depreciation policy. In the event that you have changed the depreciation policy, automatically you have to show your financial statements afresh, because before you were reporting with a different policy and now you're reporting with a different policy. So you have to show reporting with the first policy right before you change, and then you have to show what is new, and of course you have to notify the people that going forward, this is what we'll be using. So that is basically the gist of it. So what is the structure and the content of financial statements in general? Just give me a very quick second. Okay. Now, what is the structure and content of financial statements in general? You're saying that IS1 requires an entity to clearly identify the financial statements, which must be distinguished from other information in a published document. So even if, like, I'm going to refer you again, if you want to see this, you can go to any organized company's website and check the website. You will see a point where they will show you financial statements, and then they will tell you for what period, and you can be able to clearly distinguish that this is a financial statement and this is the rest of the information that they have to provide. It also has to clearly identify each financial statement and the notes to the financial statements. In addition, the following information must also be displayed prominently and repeated as necessary: the name of the reporting entity and any change in the name, whether the financial statements are a group of entities or an individual entity, information about the reporting period, the presentation currency, and the level of rounding used. Even us, when we're going to attempt our questions, we'll also adhere to these principles. If it's a group, we'll show that it's a group. If it's a sole tradership, we'll show that it's a sole tradership. Um, if it's, we'll also show the information about the reporting period. That is very, very, very key. The presentation of the currency, that is so important. And also the rounding used. So whether we use thousands or millions, will also show that. I want you to take a moment off after here and also see, and also go to any website and look for financial statements, and you'll see that these things are being adhered to. So the reporting period, we're saying that there is a presumption that financial statements will be prepared at least annually. If the annual reporting period changes and the financial statements are prepared for a different period, the entity must disclose the reason for the change and state that amounts are not entirely comparable. So if you've been preparing financial statements on a yearly basis and then this time around you're preparing mid-year, you have to let people know. Because like, even realistically speaking, if a company has made a profit of, let's say, 20 million US dollars, that's like on a yearly basis. If it prepares media accounts, that 20 million may not necessarily reflect. So someone may assume that they have now actually performed poorly. Maybe by maybe like by the 6th month of the year, they have maybe only made about 8 million. So you find that that information may not necessarily be, you cannot be able to compare information that you got media against an annual report. And so you have to disclose to people so that they also don't just know. For reporting period, we're saying that we're looking at now at the statement of financial position. That is, of course, was also what we call the balance sheet. As of currently, we are supposed to refer to it as a statement of financial position. But for the sake of this class, and I want to be a bit faster for us, I'll be calling it a balance sheet. So actually, also, I want it to sit in your head that it's a report that just has balances, because you will end up mixing it up. You may end up having issues with mixing it up with normal expenses. So once you know that it's a balance sheet, you know that it's at a close, you always know that, even in your mind, like, the more you practice, you reach a point and in your mind you can just draw a tier account in your head and just balance it off. And whatever you call the balance is what will be carried to the financial position. So we have the current and non-current classification. It's one of the ways we organize the information in our statement of financial position. An entity must normally present a classified statement of financial position separating current and non-current asset liabilities. Unless presentation based on liquidity provides information that is reliable. So in either case, even if it's an asset, category combines amounts that will be received, that will be settled within 12 months, and liabilities, that is, the current liabilities will also record amounts that will be settled within 12 months. Amounts that are beyond 12 months, they will usually be non-current. So no disclosure is required that separates the longer term amounts from the 12-month amounts. So current assets are usually expected to be realized within 12 months of the reporting period, and they're expected to be realized in an entity's normal operating cycle. So when I talk about entity's normal operating cycle, it's usually it's a year. That's like the normal operating cycle. Like for you to start from 1 to 10, 1 to 10, if let's say the cycle starts from 1 to 10 and then goes back to 1, that would be your accounting cycle. So for usually most of the companies, it's 12 months as a normal operating cycle. That's why we say it will be settled within 12 months. So, and current assets are also primarily held for the purpose of trading. For example, some of the examples, do we know any of the examples of current assets? Do we know some examples of current assets? Please feel free. What are the examples of current assets that you know? Yes, yes. Receivables, true. Cash, true. What next? Yes, true. What next? Do we have any other current assets apart from cash, receivables, and stock? Yes, cash at bank. Do we have any other repayments? Yes. Okay. So we have an idea of what receivables are. So that is good. And then we're saying every other current asset that is out of the scope of being primarily held for purpose of trading, expected to be realized in the entity's normal operating cycle, expected to be realized within 12 months after the reporting period, and cash equivalents. All the rest, if it doesn't fall under this category of current assets, the rest, it will then be non-current. So you have to also be keen about the question that you may be attempting. So current liabilities, they're saying they're also expected to be settled within the entity's normal operating cycle. They're held for the purpose of trading, due to be settled within 12 months, and for which the entity does not have an unconditional right to defer settlement beyond 12 months. That means that the settlement has to be done within those 12 months. Other non-current liabilities, apart from those that qualify under here, have to be, other liabilities that do not qualify to be under here, we will call those non-current liabilities. So when a long-term debt is expected to be refinanced under an existing loan facility and the entity has discretion to do so, the debt is classified as a non-current asset, even if the liability would be otherwise due within 12 months. If a liability has become payable on demand because an entity has breached an undertaking under long-term loan agreement on or before the reporting date, the liability is current, even if the lender has agreed after the reporting date and before the authorization of the authorizations of the financial statements for issue. So these are notes you will read through. I want us to be able to attempt at least a question today. So these are some of the items you will have to sit down and read through them. These are some of the items that are to be included on the face of the statement of financial position. Like these are things that will have to be in your balance sheets. These are things you look out for. Property, plant and equipment, that one we know. It could be land, it could be buildings, it could be machinery. Investment property, we have intangible assets. Do we know any intangible assets? Do we know any intangible assets? Do we know any intangible assets? Goodwill, yes, true. Patent rights, true. Royalty, as well. So that is good that we know intangible assets. We also have financial assets. We have investments accounted for using the equity method. Those are basically things like shares. We have biological assets, we have inventories, we have trade and other receivables, we have cash and cash equivalents, assets held for sale, trade and other payables, provisions, financial liabilities, current tax liabilities and current tax assets, deferred tax liabilities and deferred tax assets, non-controlling interest, that is for group accounts and issued capital and reserves. So these are the items that will be included in the statement of financial position. And anything else usually will probably fall under expenses and income, because when you look at these, there is nothing here that looks like it's an expense or it's an income. The statement of profit, these are some of the items that we'll be looking at for the statement of financial position, but also now for the statement of profit or loss and comprehensive income. We're saying that it's defined as the total income less expenses. That's just it. Like, for example, you take it like you have your own business, you ask yourself, how much have I sold and how much were the expenses that are incurred, and the net is your profit. That is basically what the profit or loss is about. So it's the total of income less expenses, excluding the components of other comprehensive income. Other comprehensive income is defined as comprising items of income and expense, including reclassification adjustments that are not recognized in the profit or loss or as required or permitted by other international financial reporting standards. So total comprehensive income is defined as the change in equity during a period resulting from transactions and other events other than those changes resulting from the transactions with owners in their capacity as owners. So everything else that may not necessarily fall within the normal income, that is things like when I talk about the regular income, I'm talking about revenue discounts and that kind of income. Everything else that won't fall under that will be comprehensive income for the period. So first, to find comprehensive income, we'll get our profit or loss and other comprehensive income. So when you see a question like this, you just put it's nothing fancy. You just put in your head that you have to get your profit or loss first. So you do your sales, cost of sales, expenses, and then you get, after getting your profit, you add on lines that comprise of other comprehensive income. So all items of income and expense recognized in a period must be included in profit or loss. Choice in presentation and the basic requirements. An entity has a choice of presenting a single statement of profit or loss and other comprehensive income, with profit or loss and other comprehensive income being presented in two sections. So an entity may decide to write one full statement showing that it's a statement of comprehensive income and profit or loss, and another entity may choose to write a separate statement for profit or loss and a separate statement for comprehensive income. So usually the statement of comprehensive income will go right after the statement of profit or loss. So the statements, regardless of how you do it, must present the profit or loss, total comprehensive income for the period, and an allocation of profit or loss and comprehensive for the period between non-controlling interests and owners of the parent. This is something that you won't have to worry about on this level. We don't have group accounts, but when we look at group accounts, then we'll have the whole allocation of profit and comprehensive income business going on. So the following minimum line items must be presented in the profit or loss section or separate statement of profit or loss if presented. Just like you see, we have revenue, that is usually we get it from our sales, money that we make off sales, we also call it revenue. We have gains and losses from the recognition of financial assets measured at amortized cost. So things like when we buy an asset, we have amortized it, and we've decided that maybe we're going to dispose of, we're going to get it out of our register. If maybe we're getting it out at a profit or we're getting it out at a loss, we will have to show that those are items that will be included in our financial statements. We have finance costs. Those are basically charges on financing that you get for the business. So if you get the bank loans for the business, the cost of getting that loan will be the finance cost. So the interest, last time I had a student who asked me why we had the loan interest. I think it was something to do with we had the loan interest in our P&L and also our balance sheet. And I mean, we also had a loan in our balance sheet. So the loan will appear, of course, as a liability, but the cost of that loan is an expense that we'll be paying on a yearly basis, and that will be our finance cost. We have the share of profit or loss of associates and joint ventures accounted for using the equity method. This will look at much better when we're looking at partnerships, but just for the sake of it, of course, if you make up, if let's say you're in a business, two people, and maybe you're owning 50-50, of course you have to share the profit. And that's, as accountants, we have to show that this person took the 50 and the other person also took the 50. We have certain gains or losses associated with the reclassification of financial assets. So we may have our land and we revalue it, or we move it from basically it may be a revaluation, or maybe like a change in policy, that kind of thing, or our receivables being affected. For example, when we write off a bad debt, when we provide for a bad debt, maybe we provide 10%, and in the next period we end up having to provide only 5%. That other difference of the 5% that we have, the reduction of the 5% will probably be a gain that we have to show in our financial statement. We have to show in our profit or loss. And of course, maybe if we provided for 10% and now we have increased the provision by 15%, then that extra 5% that we have again reduced of our receivables will be a loss that we have to show. We also have tax expense. So after you have gotten your profit, of course, you will have your tax. So you may have the tax expense will be in two forms. It will be in the tax paid in that particular, it will be a tax paid in that particular year, and then the tax payable for the year moving forward. So we also have a single amount for the total discontinued item. That's in case we have written off any items. Expenses recognized in profit or loss should be analyzed either by nature, that is raw materials, staffing costs, depreciation, or by function, that is cost of sales, selling, administrative, among others. If an entity categorizes by function, then additional information on the nature of expenses at minimum depreciation, amortization, and employee benefits expense must be disclosed. So what we're trying to say is that when we are writing these assets, we have to also classify them, just like we saw with the liabilities. Just like we saw with the financial statements, with the balance sheet, we organize the balance sheet according to order of liquidity. For expenses, we'll organize them either by nature of the expenses or by the function of the expense. So of course, it will depend on the industry that you're working in, or what kind of accounting what kind of company you're reporting for. For example, an insurance company will have a different reporting from a manufacturing company. So we'll look at manufacturing and then we'll see how that goes. So you find that with manufacturing, we'll have different kind of costs. We'll have overheads, we'll have direct costs, and then we have everything else. You find with maybe like with a regular business, most of the times it will be recognizing or categorizing by function. So that is, it's not very, very stringent, but it's also very important that you have work that is organized and you can also be able to report in an organized way. So the other comprehensive income section, we're saying that it is required to present line items which are classified by their nature and group between those items that will or not be classified, will or will not be classified to profit or loss in the subsequent period. And then additional line items may be needed to fairly present the entity's result of operation. Items, we're also saying that items cannot be presented as extraordinary items in the financial notes or in the financial statement, sorry, in the notes. So there is nothing like this one is special and this one is not. Certain items must be disclosed separately, either in the statement of comprehensive income or in the notes if material. And some of these disclosures, some of the items that we will have to look out for when it comes to disclosures, we have write down of inventories to net realizable value. That is, let's say you have inventory worth 10 million, but the net realizable value is maybe 9.5. That is something that is very noteworthy and you have to include it. Plant and equipment recoverable amount, as well as reversals of such write down. So you could write down inventories, you could write down plant and equipment. We have restructuring of activities of an entity and reversals of any provision for the cost of the restructuring. So you might have provided at one point, just like we see the example of the 10% provision. You might have provided 10% and now you need to reverse the 10% and put a new rate. Those are things that you have to disclose. Dispose of items of property, plant, and equipment. Usually, like I've said, when you go to those websites, you will see it will probably be like a single line of property, plant, and equipment. But when you break that down, usually for big companies, it will be so many assets, but they will just be summarized in like 5 lines. You find that an asset register has maybe over 200 lines or something, but when they are reporting, it's like 5 lines of all those 200. So in the event that there was a movement in any of those 200 lines, the notes are what are going to help you know what exactly happened to that particular item. Otherwise, you might never know. And then also there's no way they're going to report and now report on the chair, office furniture, now plant, the machine one, machine two. No, you will summarize all of them as plant, property, and equipment. We have disposals of investments in case maybe a business had investments elsewhere, they had a controlling interest elsewhere. That has to be disclosed in case there was a change or in case there is any change there. We have discontinuing operations, of course, like we said, in case you are not going to be operating a going concern, you have to clearly tell people that that will be the last year and you're trying to wrap up business. Litigation settlements, this is very important because people must know what is exactly happening. People must know what you're anticipating. You may have court cases going on. So these litigation settlements will show them in terms of provisions, okay, in terms of contingent liabilities and assets. And we have to disclose these contingencies. And then we also have other reversals of provisions. So in case you made a provision in 1 year and you've decided to reverse it, you have to clearly communicate about that reversal. So let's just go for a 2 minutes break and we can look at accounting for a sole trader. Can you see my screen? Can you see my screen? Right. So we're going to start with the accounts of a sole trader for today, and then as we go forward, we'll also look at the rest of the other types of businesses that may exist. But once we understand the foundation of accounts of a sole trader, we will be just building onto that. We'll be making adjustments. But if we've understood this, then it will be a bit easier for us to also understand the rest. So try to pay attention and ask where you feel you're not comfortable. So the major statements for financial for a sole trader, the major statements that we'll consider are going to be the statement of comprehensive income and the statement of financial position and the cash flows. So we're saying that the statement of a statement of profit or loss and other comprehensive income, we're saying it's a report that tells the profits of a business for a period of time, and it involves grouping of revenues and expenses prior to bringing them together to compute a profit or loss. And it's a time called the trading profit and loss account if it is prepared to show the gross profit and the net profit. So I know you might have done businesses or you are trying to do businesses and you say you're balancing yourself, you're trying to see if you're making money. What you're trying to do there in that point of you trying to see if you're making money is in your mind, you're trying to calculate, you're trying to make an income statement or a P&L. So basically, you will get the money that you've made off the sales, that is your gross revenue, your gross sales, minus the cost of those sales and any other expenses that you might incur. When you offset those expenses against that revenue, you're able to determine whether you have a profit or not. So basically, that's what we'll be looking at today. It's just that we're going to be looking at various adjustments or things that could come about as you're trying to ascertain whether you've made a profit or not. But the baseline of a P&L is for you to know whether you made a profit or not. So gross profit is the difference between the sales and the cost of sales that have been sold. You will sell your goods. Today we are having a business of let's say bags. We will sell our bags, and maybe for us to be able to sell those bags, maybe let me just get my pen here. We have our bags, and we have sold maybe 10 bags, each bag at 100,000. So 10 times 100, that should be 1,000,000. Going to make it 1M. But maybe these bags cost us, each bag cost us 50,000. We are just by eye, and we've decided to add a whole 100% profit. So 50K times 100, sorry, times 10 bags. So meaning that we actually spent 500,000 in buying the bags. 500,000 is equivalent to 0.5 million. So for us to know whether we've made a profit or not, like this is just at the basis of it. For us to know whether we've made a profit or not, we'll get the 1 million that people have given us minus the 500,000, giving us a profit of 0.5 million. That's assuming we didn't incur any other expenses, but um maybe we had an employee that we paid 100,000. So you will get that the gross profit that you've now gotten, and you remove the 100,000 that you gave your employee until you get your net profit, which will be 0.1. This is the money that you're going to cash out and make your own. If it's a sole tradership, it would be your own. If it's another kind of business, you will take it to your retained earnings. Even in a sole tradership, you take it to retained earnings, but when you pick it out, you will reduce your retained earnings, like we will see with our trading. For those of us, did you guys look at the accounting equation? Were you taken through the accounting equation at the beginning? Are you taken through the accounting equation? Okay, I'm hoping you are. The accounting equation is basically you knowing that your assets are equal to your liabilities and then expanding that over and over and over. And I hope you had like questions that were trying interviewing you on that. So the statement of profit or loss and other comprehensive income, we have said it's going to have a trading account. So the 0.5 million that we have gotten, we got a 1 million minus the 500,000 cost of the bags, and we got a gross. That is our trading account. So we get our trading account plus our expenses. So that 0.1 that I added was now our other expenses. So cumulatively, we'll call that our statement of profit or loss. So if we are saying that the gross profit is the difference between the sales and cost of goods that have been sold. If sales are more than the cost of sales, it results into gross profit. If the cost of sales is more than the sales, it results into gross loss. The part of the statement that calculates gross profit is called a trading account, like I've shown you. The cost of goods relates only to the goods that have been sold. This is very important. Please remember that the cost of goods relate to the goods that only and only have been sold. Therefore, reconciliation is made for the opening and the closing stock. For you to be able to know how much goods you've sold, you will let's say we want to know how much goods we've sold from Jan to June. We have our bags. Maybe we started off with 100 pieces of bags, okay, in Jan, and maybe we added maybe 50 bags. So we added 50 bags. We call them bags, not millions. Okay. You saw me do this last time. So we opened our year. We opened our 2024 opening stock. We had 100 bags. And then we purchased 50 more bags from, so far we purchased 50 more bags. So I'm going to show that we purchased our 50 bags. And then after that, so right now when we go back to the store and we count, maybe when we go back to the store and we count, so let's say we are reporting as of June. So our closing stock as of June, maybe we go back to the store and count and find out we have 60 bags. So that means that we are going to just reconcile and see, get the difference. That means ideally whatever we sold should be the difference of what we had. So if we opened up our shop and we had 100 bags and we purchased 50 more bags, means that we have a total cumulative of 150 bags. But if the store has only 60, it means that 90 bags, because 150 minus 60 is 90 bags. It means 90 bags got out somehow. So ideally, if there is no fraud, if there is no destroying of anything, 90 bags were sold. So if we are to get the cost of sales, we'll be getting the cost of sales for these 90 bags. So it may be very, very rare to be given questions to do with reconciling the stock. But in case you have to reconcile stock, it's the same formula: opening stock plus purchases minus closing stock. Usually at this level, you'll be given just values. So if instead of the 100 bags, you'll be given maybe 100 million, and then 50 million. Okay, and then the closing stock will be worth 16 million. If we are maybe selling them at a markup of 0.5, if 100 bags are worth 100 million, means that each bag is 1 million. So a markup should be, if we're given a markup of 0.5, that should be 50%. So that means we're selling our bags at 100 and at 1.5. So we sold our 90 bags. Indeed, the cost of these 90 bags was 90 million. So you may find that our sales, for example, I'm just giving an example, our sales are maybe 90 times 1.5 million. So you get the total of that. Someone, if you have a calculator, you can multiply. That should be 90 plus 450. Let's see, 90 times 1.5 million. should be 135 million. So if your sales are 135 million, for you to know whether you made a profit or not, you get the cost of bags sold. The bags sold are 90 million. So I know this 90 million because I've gotten my opening stock plus purchases minus closing stock. And I know that it's 90 million. So I'll get my 135 million minus my 90 million. The difference that I get there, that should be about 45 million, should be my net, my gross profit. So what I've just done here is what we call our trading account. So I've calculated that for you. So I'm just going to take you through the notes here. This is how we are going to calculate our cost of goods sold. That is the formula I've just taken you through. Opening stock of the goods plus purchases minus closing stock. This is standard procedure whenever you're reconciling stock. So the net profit, we think, is computed in the profit and loss account. So after we've gotten our gross profit, we'll now get our net profit. Net profit is less of any expenses that are incurred during the period. So for us to get the net profit, we get our gross profit plus other revenues from other than from the sale of goods minus expenses incurred during the during the period. So what are the other adjustments? We have looked at the basics. So what are the other adjustments that we may have to make in the income statement? We have return inwards. Now, when we make a sale, imagine I've sold my bag. Let me see who I've sold my bag to. Who is going to be my customer? Fred, you bought a bag from me. So now Fred maybe has bought a bag from me to take to his friend. Okay. Then maybe we find out that maybe Fred reaches there and finds out that the friend doesn't like the bag. And so they decide to say, you know what, maybe the bag has an issue, maybe they're allergic to that material. It could be any justifiable reason, not just going up and you say you don't want the bag. So they bring the bag back to me. So the moment I sold the bag to Fred, remember our accrual concept. The moment I sold the bag to Fred, I sold my bag worth 1.5 million to Fred, so I'm going to debit, and I debited my receivable, or maybe Fred gave me cash. So it could be my cash stroke receivable. Okay. And I credited my sales because my income was increasing. So I credited my sales. But then Fred comes back after like 2 days or more and tells me, you know what? The bag that you gave me, my friend doesn't like it, or my friend is allergic. Could I have my 1.5 million back? So I'm like, okay. So what that means that my money is going to reduce again now by the 1.5. So ideally, I'm going to debit my sales. Okay, I'm just going to reverse the first transaction and credit my cash, because my cash is reducing and my income is also going to reduce, or my receivables are also reducing. Okay, so now instead of calling it sales, we'll call it sales returns. So sales returns reduce our sales, and they reduce our sales by we debit our sales returns. So returns outwards. Returns outwards are deducted from purchases. This time around, maybe I'm the one who has gone to Fred to Sugula bags from Fred. So I'm going to debit my purchases with, if I've Sugulaed my bag, maybe I've bought at 150 million, I've debited my purchases with that 150 million. Of course, I'm going to be supposed to be paying, so my liability is going to increase. Or maybe I gave cash, so my cash is going to reduce. But then turns out that maybe 20 million worth of these bags is just poor quality, so I'm going to take back. Usually you may not necessarily, even the returns, someone may not necessarily return all the sales that you have made. It will just be like a figure of it. So maybe I am returning 20 million worth of these, purchases. What that means is that I'm going to reduce my purchases by the 20 million, and I'm supposed to be reducing my payable, or he's supposed to be giving me back my cash of 20 million. Okay, so instead of calling these purchases, they will be returns, purchases returns, or returns outwards. So be very key about the words returns outwards and returns inwards. Inwards, returned, they are deducted from sales. People are bringing back. Returns outwards, you're the ones taking out of the business. So that is the concept of returns. I hope we've gotten it, because it's something that is highly asked about. So for the carriage inwards, it's always added to the cost of goods in the trading account. So let's say my bags, I have gone to Fred and I bought my bags for 150. Usually the transportation of the purchases themselves, the transportations of the goods that I'm going to trade, the cost of transport of the goods I'm going to trade is what we're going to call the carriage inwards. The cost it takes for you to get your product from wherever it is to the point of sale is going to be your carriage inwards. So maybe I bought my goods from Fred. I indeed have debited my 150, but then I also spent an extra 10 million in transport. This will be an expense and it will be a carriage inward expense. It will affect my trading account as well. It will affect my cost of purchases. So my total cost of purchases will be the 150 that I've paid for the bags plus the 10 million I've paid for transport. I need you to be very particular for the carriage inwards. The returns inwards and outwards will both affect the trading accounts. But for the carriage outwards, it will be deducted from the gross profit. So for example, back to my bags for Fred. Fred, this time around, when I pay for myself that 10 million for transport, okay, we have our 150 plus our 10 million for transport. When me, the business, I pay for myself that 10 million, it will be a carriage inwards. When Fred pays for me that 10 million, Fred's business, okay, Fred's business will record that as a carriage outwards. So basically, you see like how these online businesses say delivery is free, delivery is free. That is a carriage outward, and it reduces their gross profit, not their net profit. Please take key. Carriage inwards affects the trading account. Carriage outwards affects the gross profit. Returns inwards affects the sales. Returns outwards affects the purchases. So of all these returns, carry inwards and outwards, returns inwards, returns outwards, carriage inwards, trading affects trading. Carriage outwards affects the gross profit. Be very careful. So when sales and purchases are put on the sell line in the trail of balance, the figure in the debit column is for the purchases, and the figure in the credit column is for the sales. This we know by now. We know the thing is, when you're spending money on the TB, on the trial balance, when you're spending money, you will debit. Every time spending money, it will probably be a debit balance. So all the expenses that you incur on the trial balance, they will have a debit balance. Okay, let me show you an example. Let me just show you how that comes about before you cram. Let's say we have, maybe we are business and we have rent to pay. Sorry, I don't have my mouse, so I may not be able to draw a good T account for you, but I'm just going to try. Should it be this? So when we have our T account like this, and maybe it's a rental account. Remember, when we pay rent, we're going to debit a rent expense. So let's say we have paid rent of 5 million as a business. When we are balancing off this rent account, the balancing figure will be on the credit side. So we'll balance, normally, we'll balance off our balance. Our balance carried forward will be 5 million on this side, on the credit side in our T account. Okay. But when we are to make a double entry for this, or when we are to balance again this off, and we have to take, because after putting this in your T accounts, you will take them to your general, your trial balance. So here it closed off on the credit side. Here it's going to be, sorry, in your TB, the TB will be in lines like this. So in the TB trial balance, it will be on the debit side, because on this side it was on the credit side. So if you're not sure where what goes where, just usually just do a balancing off in your head. Assets have a normal debit balance. Now we can just look at it. We have our assets. We have liabilities. We have income. We have capital. We have equity. These are the components of our financial, our accounting equation. I just want you to remember this. I'm going to say this, and the next time I'm not just going to say assets have a normal debit balance. So please get this, keep it in your mind. Assets have a normal debit balance. That means that ideally they are supposed to be a normal debit balance. That means that in your TB they will be on the debit side. If they're on a credit side, that means that something is wrong, because it would be an anomaly and you have to investigate it. So even when you're doing questions to do with errors, it's important for you to understand your double entry. So this is just a summary of the double entry. Liabilities have a normal credit balance. Income has a normal credit balance. Capital has a normal credit balance. Equity has a normal credit balance. So when you hear someone saying liabilities have a normal credit balance, means that when liabilities increase, we credit them, we write them on the credit side. That is what basically these things mean. So this help you with they're like pivot points for your double entry. When you see money coming out of a business, when you see expenses, you will know. Sorry, let me add expenses here as well. Equity, capital, expenses. These ones have a normal debit balance. So when you see that something is an expense, ideally it should be on a debit side. But if you open up your TB and you see that an expense is on a credit side, it means that there is money that you're actually demanding people, because ideally when you're paying out money in form of expenses, it should be debited. So these are some of just the things that will help you clearly. They will help you run through a TB very fast. When you understand when you understand this table, you have basically finished half of your accounting problems. Okay, can I remove it? I'll take it that is, okay. So we're just going to look at the format for sole trader accounts. Format for sole trader accounts. This is how our cost of P&L for sole trader is going to look like. Of course, we have our title, our heading, clearly showing the name of the business, what the statement is about, the period. This word for, as at, please make sure you know what goes where. When it's a P&L, it's for the period, because you're looking at expenses and incomes that happened within that period, like inside that year. So it's for the period ended December 31st, it could be whatever date. So we will have our sales. They'll look like that. The return inwards will reduce our sales, so we'll have less return inwards. And after reducing our sales, we'll have our adjusted sales or our net sales. And then after getting our net sales, we need to be able to get our gross profit. So we'll get our openings. We will adjust the cost of sales. As at is for the balances, because you're closing the year. So balances, balance sheet, that's when you use as at. So for the cost of sales, we'll add just to be able to get our profit, we get our opening stock, and then we'll add our purchases, and we'll add our carriage inwards, and we'll less our returns outwards. I've explained this concept. And then we'll also less our closing stock. After getting the cost of sales, the total figure of the cost of sales, we'll be able to get our gross profit. And in case we have any other revenues that we might have received, maybe the business has other sources of income, we'll add our revenues. So it could be rent, it could be commissions, and they will increase our income. And then thereafter, we will remove our operating expenses. So we'll have our administrative expenses first. As you can see, we have wages, salaries, wages stroke salaries. We have our rent payable. We have our legal fees. These are just some of the examples. We have our lighting and heating. We have our depreciation of the equipment. And maybe in case we made a donation, we'll also add it there. And so after getting the total of all these expenses, we'll have our net profit or loss. If it's a profit, it will be a positive. If it's a loss, it will be a negative, and you're supposed to indicate so. The statement of financial position contains, now that is how, this is how our P&L will look. This is how our P&L will look. And then moving on, we have the statement of financial position, or what we could also call our balance sheet. It contains the details of the assets, liability, and capital. So the amounts to be entered in the statement of financial position are found in the trial balance. What you're supposed to pick, what you're supposed to enter. Usually it's usually straightforward unless there are adjustments. You will pick those from the trial balance. So we have assets, and the saying assets of two types, like we saw, the non-current and the current assets. I'll not talk further about those. We have already looked at them. And then of course the liabilities we also know. We have our current liabilities and non-current liabilities. All right, let's see. Give me a second. Okay, I've sent it to your group. You should be able to receive it. So the format for the financial statement, for the statement of financial position, we will have our assets first. Our assets will always come first. Remember our title is there, Musoke Enterprises, statement of financial position as at. So we have our assets, we have our non-current assets. Here we organize in order of liquidity. Like when I say order of liquidity, I mean the thing that would be the hardest to sell is what you put first. The thing that would be hardest to liquefy is what you put first. So you organize it from top to bottom, order of liquidity. So we have our land. I'll put it there. We have at this level, this is how the report will look like. We have our buildings, we have our motor van, we have our fixture and furniture. Usually these are the common types of non-current assets. Then we have our current assets, could be stock, which is now called inventory. We don't call it stock. So in the exam, don't write stock, right? Inventory. We have our debtors, we have our bank, and we have our cash, like you've seen, order of liquidity. So of course we'll add those up and we'll have our total assets. So then we'll have our capital and liabilities. That is the capital introduced. That's the capital that's also introduced in the business, less any drawing. So when you pick money from your drawings, you're eating your capital ideally. So it will reduce on your drawings will reduce on the capital, and then the net profit for the year will be also brought, the profit that you're going to get from your statement of your P&L, or the loss that you get from your P&L will be added to your capital here. And so that will be your total capital. You get your total capital. In case you have any non-current liabilities, you will put the total value of the non-current liability. So if you got a loan of 40 million, you will show that you got a loan of 40 million. And then we have current liabilities, which will usually be accounts payable. And in case maybe you have a bank overdraft, it will be there. But in case there is an interest on this overdraft, the interest will be showing in your statement of your P&L as a cost. In case you're paying an interest like 10% of this loan, that 10% will also be showing the other side as a cost. So that is how that's a pro forma. I'm just going to give you 2 seconds to just look at it, and then we can look at something else. Creditors are the same as your payables. So when you see accounts payable, that is, those are your creditors. So we don't call them creditors anymore. So in your exam paper, please take note of the terminology. We here in class we may be calling them creditors and debtors, but they are either accounts receivable or accounts payable. So accounts payable are the same as creditors, and then debtors we shall have to call them receivables. Okay, it's fine. That is one of the questions you can just go through during your free time. I'm going to take us through. I'm going to take us through one question. Let me know once you can see my screen. Could you please rephrase the question of the why? Oh, it's a yes. Oh, okay. We'll be looking at Mobilu Eric Enterprises. So let me know when you see a question that looks like it has Mobilu on it. All right. Huh. So I'll share this question after here. We'll attempt it in full next lecture, but I need us to go through it so that next time, I'm just going to run through it next time, and I hope you remember. So I'm going to, we're going to read through the question and then we can attempt it next time. But so half the work is going to be done today, so next time we will just do it for like 30 minutes of the lecture and then we can move on to something else. So please don't log off just because I've said we shall do it next time. The following trial balance has been extracted from the ledger of Mr. Mubiru Eric, a sole trader. This is how our TB looks like, our trial balance looks like. We have our debit side, we have our credit side. Like you can see, sales usually are income. They have a credit balance. We have purchases, of course, they are on a debit side. The carriage, this is on a debit side. We have drawings, 7,800. We have our insurance on a debit, postage and stationery, all these are expenses. They're on a debit. Advertising, salaries and wages, recoverable debts, also on a debit. We have allowance for receivable, it's on a credit. So we're going to find out why it's on a credit. We have our receivables, it's on a debit, it's an asset. We have our payables, it's a liability, it's on a credit side. We have our cash on hand being 177. We have our cash at bank at that much. If maybe we saw our cash at bank on our credit side, then we would know automatically that's a liability, and that would just automatically tell us that we have an overdraft. We have inventory, 11.9. It's on, of course, debit, it's an asset. Equipment at cost, that's an asset, it's on the debit side. Accumulated depreciation is there. It's on the credit side as it's supposed to be. And then we also have our capital, which is on the credit side. So they're telling us that the following information is available as of 31st May 2020. Before I go to the notes, they tell us to prepare the statement of profit or loss and comprehensive income at the year ended 31st May 2020 for the year ended. So you can see also, if you're not sure whether to use hazard or for, usually the question is an indicator. So when you see the question saying, prepare a restatement of profit or loss and other comprehensive income for the year ended, you will just leave out the word prepare and carry everything else and appropriately put it as your title. And then they've also told us to prepare a restatement of financial position as of 31st May 2020. So they've told us rent is accrued by 210. Knowing our accruals and prepayment concept means that we didn't pay all the rent. Just by looking at the word rent is accrued by 220 means that we didn't pay all the rent. So that means that automatically I will know that when I come and look at my rent expense, this is rent and insurance, is 6.6. So when I look at this 6.6 million, I am supposed to add an extra 210 because the rent has been, when you hear that rent is accrued, the moment you see the word accrued means that there is money that was paid is not, the moment you hear the word accrued, it means that not all the money, not all the rent that was utilized would actually paid for. That means that we closed the year and they were demanding us 210. Insurance has been prepaid by 880. So that means that this 6.6 that I'm seeing here, okay, has a prepayment of 820. So and we know that the prepayment usually relates to the next or the following period. So I have to remove that prepayment from the 6.6. And then they're telling us 2.2 of carriage inwards represent inwards on purchases. So of this 5.1, 2.2 of this money is a carriage inward expense. So we will get the 5.1 minus the 2.2 and be able to know how much is carriage inwards, and the rest should be carriage outwards. Then they're telling us equipment is to be depreciated at 50% per annum using straight line method. Equipment here at cost, we saw that it's 58,000. So we'll just get our 15% times the 58 to get our depreciation cost for the year. That is for the P&L. And then when we are going to our balance sheet, because we already have our accumulated depreciation, we'll get the 19 plus the 15%. That's the 15% of the 58,000. And then they've told us that the allowance for receivables is to be increased by 40,000. So we are going to get this 130, and we're going to add, because this is already also, we're going to get that 130 and we're going to add our 40,000 to be able to get our new allowance for receivables. Then they're telling us inventory at the close of the business has been valued at 13.5 million. So that means that our closing stock is going to be 13.5 million. So this question is pretty, it's very, very summarized. It should be okay for us to do. Do you have the mental capacity for me to go through this question now? Let me take us through the question. We will finish a bit late, but let me take us through the question so that we can look at something else next time. Who else is with John Baptist? Okay, since we don't want to go through the question, I'm just going to also just go over the next, this 15.2. So that we just get a feel of how these questions look like, and then we can fully attempt our movie next time. So 15.2, Donald Brown, a sole trader, extracted the following trial balance on 31st December 2014. This is Donald's trial balance. Before I even read through, I usually want to know what the question wants. So they want us to prepare a Donald statement of profit or loss and other comprehensive income for the year ended 31st December 2014, statement of financial position, and given the facts in the Donald Brown question above, what is the net effect on the profit of the adjustments? What is the net effect on the profit of the adjustments in A to C? So I know the expectations of the question. I'm now just going to attempt it and see. So we are seeing Donald has capital of 26 million. It's on the correct side, so that's okay, straightforward. Receivables of 42, that's okay. Cash in hand of 1.4, that's okay. Payables of 35.4, that's okay. Fixtures and fittings at cost, that's okay. So some of these things, the more you practice these questions, and by the way, try to practice as much as possible. The more you practice them, the easier they will get. Discounts allowed, we allowed the discount, so it's an expense to us. We looked at discounts allowed when we were looking at our cash books. So that will be money that we lost. Of course, it will be a debit in the TB. Discounts received will be an income in our books. That will be the 1.1. Inventory as at 1st January should be the opening stock. It's 18.4. We had sales of 491, which is good. We had purchases of 387. We had the cost of motor vehicles, lighting and heating. This is the expenses. Motor expenses 2.8, rent 8.8, and general expenses 7.4. These are just expenses and they're straightforward. Then we had our bank overdraft. So it's clear that told us it's a bank overdraft of 19.8. So this is it's our non-current, it's a current asset for us. Provision for depreciation, the fixtures and fittings, that was what was depreciated. And motor vehicles, we have 15.2 for what was depreciated. Donald seems to have picked out money also. He had 26.5, he picked out. That, of course, reduced his capital. So the following information is also available. Shillings 218 is owing for motor expenses. This is the same as saying that there's an accrued expense for motor expenses. So this 218 will add it back to our expenses so that we get the total. We'll add it back to our motor expenses so that we get the total expense for motor expenses. Then we have 680 has been prepaid for rent. We'll remove that from the total rent expense that we are seeing here so that we get the net rent expense. Depreciation is to be provided for the year as follows. We're depreciating motor vehicles on 20% at cost. So we'll come and get our cost of motor vehicles, which should be about 40 something. I saw it up here. 45, 20% of 45.7 should be our depreciation cost for the year. Fixtures and fittings should be the 10% is 10% on reducing balance. So we'll get our cost of fixtures and fittings. Where is the cost of fixtures and fittings? The 42.2. We subtract the depreciation that we have so far, and the difference, we'll multiply it by 10%. So we also have the inventory at the close of business, which was valued at 19.9. That's the closing stock. It will affect our trading balance, and it will also show it as our asset in our statement of financial position. So the Donald question, I may not be able to attempt it next week. I mean, sorry, on Wednesday. But please, I have taken you through it. Kindly attempt it and reach out in case you have any questions. So basically, that is how we look, and it also has a solution. So try to attempt it first without looking at the solution. Don't cheat yourself, because looking at the solution is cheating yourself, not me. Try to look at it and attempt it. So for the P&L, sorry, for the balance sheet, this is how Donald's balance sheet will look like. You can try to attempt the P&L on your own, and then it's okay. You can just look at the balance sheet and read through it. So that's how it will look like. Do we have any questions? Do we have any questions?
Yes.
Yes, please.
So I have seen your statement of income statement, the income statement or the TB was reading data, and in the question down I was seeing receivables. So I wanted you to clarify more the difference between data and the receivables. Which right word are we supposed to use in the TB?
The right terminology is receivables. I think about like 3 or 4 years ago, we used to use data, but as per the updated accounting standards, we are now required to use the word receivables. So you go with receivables. So sometimes you may just attempt old questions, then they will have the word data, but that's not what you write.
Okay, I also have this question. Previously, I was discussing with my friend. I heard of errors that do not affect the trial balance, don't come up with suspense accounts. But I got this question, it was an error, and it was as if it could not affect the trial balance, but it could bring a suspense account.
Why did you think it had to bring a suspense account?
It's like this, discount of 30 had been debited to the discount allowed. Discount received had been debited to discount allowed.
Okay, and let me just write the error, and then we can go through it. So the error is the debiting.
Discount received was debited to discount allowed.
Discount allowed. How much is that?
Any amount, it can be 30 at 300.
Discount received was debited to discount
Allowed.
So this is how the error looks like. Okay, let's say it's 30,000. So that means that we actually received a discount of 30,000. So if we received a discount of 30,000, it means that ideally, we're supposed to credit our income, our discount received account.
Yes.
Discount received. We're supposed to credit it with a 30,000. So ideally, if we are to correct this error, we're supposed to just make a reversal where we're going to credit our discount allowed and debit our discount received. Isn't it so? Ideally. But because let me just this sorry. Oh dear. The question showed us that we had debited our discount allowed with the 30,000 instead of the discount received. So if we just do a reversal, it's going to cancel out. If you carry this 30,000 and put it in the discount received, like if you put it here in your discount received, so that means that you'll be carrying it from Let me just elaborate. So if you're to correct the error ideally without the whole concept of doubling the 30, you correct it by saying discount received, by crediting the discount received, and then debiting, because now you'll be putting the 30K in its actual account, and for you to remove it from the account it wasn't in, you will debit the discount allowed, you reduce the discount allowed with the 30,000. But now when you do this, ideally when you just carry the 30K from one place to another, you're crossing them out. So what you will do, you will debit the discount received with a 60,000. So ideally, yes, when you write the 30, they are crossing each other out, okay? But now you need to have 130 in at least the discount allowed. So what you're going, sorry, in the discount received. So what you will do, you will write 60,000. You will double the 30K in the account that it's supposed to, it's in the account that is supposed to be receiving the correction. So that the 30K that is in error will be against the 30K that is being affected. But then also the question didn't tell you that, the question told you that we have discount, the question told you that you debited the discount allowed, right? You credited the discount allowed.
Yes.
Yes, so the fact that it was one account that was affected, you may have, it may may need you to come up with a suspense account. So for you to correct the error, you're going to debit your discount. You said the 30K is in the discount allowed and we debited it, so you're going to credit. You're going to credit your discount received with the 60, and then you're going to debit the suspense with the 30 to correct that error. So that 130 cancels out with the other 30, and then the correct account has the 30 itself. So if we credited it in the discount, if we credited the discount allowed with a 30, we are going to remove it from the discount. How we remove it from the discount allowed is by creating a suspense account so that we can be able to remove the 30K from the wrong account and put it in the right account. So you take it like the suspense is like it's like a bridge that helps us connect and pick and get the wrong figures and put them in the right places. Why we can't just move from discount, why we just can't use just these two accounts, allowed and discount received, is because the question told us that it affected just one. If it was maybe an error, maybe misposition, and they had told you which accounts had been affected, like two of the accounts had been affected, then there you would use both the two accounts. But in the event that you've been given one account, then you have to create a suspense account.
Yeah, so, right. Because for me, I had this discount allowed. I canceled it out from the debit. The discount received was debited. But for me, canceled out by crediting. I credited discount allowed and I credited discount received by 30 to make 60. Then I created the suspense on the debit of 60 again. But my thinking, that was an error of principle. I don't know whether I was right.
No, it wasn't. What is an error of principle? What do you think an error of principle is?
It is posted on the wrong class of accounts.
But they are similar classes.
These ones?
They are both discounts. Yes.
Okay. Have a good night.
All right. Thank you. Do we have any other question? Okay. Thank you for the questions. Thank you for attending. I'm sorry I was a bit late. Please have a good night.